So today, right, welcome to the fourth episode of our Basics of Leasing series. Today we'll be focusing on accounting for lease transactions. While technically I'm going to talk about accounting for lease transactions, but we're talking about something extremely basic, extremely fundamental, and something which is almost existential for the leasing industry because much of the current acceptability, sellability, marketability, doability of lease transactions, plus the regulatory implications. In a lot of ways, even the tax implications, the IBC implications are dependent on whether the lease is a financial lease or operating lease. The rights of parties, though, like we discussed during the discussions on the legal aspects of leasing last time, the rights and liabilities of parties are agnostic or independent of whether the lease is a financial lease or operating lease, but a lot of regulatory implications get changed based on the characterization of the lease as financial versus operating. We had in the first episode discussed what's a financial lease, a lease which is substantially a financial transaction. Substantively, in substance, that is by way of overall risks and rewards, the lease is a financial transaction. The lessor is exposed to financial risk and financial rewards, and the lessee is exposed to all asset-based risk or rewards. That's the overall meaning of a financial lease. A lease which is not a financial lease becomes an operating lease. The classification of a lease as to whether it's a financial lease or operating lease is done not based on the terms of the lease contract. It's not based on the terminology or the legal facade of the lease contract. Because please understand that the moment you're talking about financial lease or operating lease, we are going beyond the form and looking at substance. So it's not an approach which is based on the form of the contract or the language of the contract. It's an approach which is based on substance of the contract. So language of the lease agreement, caption put on the lease agreement, language used by parties, terminologies, nomenclature put by the parties, title put by the parties, all of these will become irrelevant when understanding the classification of the lease. I was saying, therefore, the classification is done based on intrinsic substance, not based on language or terminology. That's part one. Part two, the classification is done at the inception of the lease. That would mean the characterization of the lease is done at the start of the lease contract. Subsequently, if the contract gets restructured, for example, there's a restructuring of the lease, we might reopen the question whether the lease is a financial lease or operating lease. But otherwise, we answer and freeze the question throughout the life of the lease contract as to whether the lease is a financial lease or operating. In a sense, the classification or characterization is done at the inception of the contract, not subsequent based on the behavior of parties. Now, before we get into the discussion on financial versus operating lease and therefore the accounting nuances, let me once again very quickly recap for you. That if the lease is a financial lease, the accounting by the lessor will not be reflecting the fixed asset on his balance sheet. The lessor will be reflecting the receivables. If the lease is a financial lease, a lessor will not be reflecting the fixed asset on his balance sheet. He'll be reflecting only the receivables. That's lessor accounting. When it comes to lessee accounting, it depends on which accounting standard is the lessee subjected to. If the lessee is subjected to the accounting standard that I mentioned on top over there, the accounting standard I mentioned here, which is Ind AS 116, the lessee is following Ind AS. The lessee is following Ind AS. The lessee is Ind AS complying entity. In other words, the lessee would be following Ind AS 116 or IFRS 16, the accounting standard on lease accounting. In that case, the accounting by the lessee will follow a certain will follow a certain classification or will follow a certain measurement approach, recognition approach, which we just discussed. If the lessee is not adhering to IFRS or Ind AS, that would mean the lessee is covered by IGAAP. Then the IGAAP, that is the generally accepted accounting principle, minus IFRS for lease accounting will be the earlier accounting standard, which in this case would be AS 19. So the accounting by the lessee will be dependent on, is the lessee adhering to IFRS or Ind AS, or the lessee is following IGAAP. In international context, other than countries which have adopted IFRS 16, I would earlier mention that US happens to be one of the major jurisdictions which has still not adopted IFRS, and therefore in US the accounting for lease transactions is done based on ASC 842, which is also equivalent, not exactly equal to IAS 17. Therefore, there also the accounting is based on our AS 19. So accounting for lease transactions depends on, for the lessee, depends on which accounting standard is the lessee adhering to. But for the lessor, the distinction between financial leases and operating leases becomes critical for lessor accounting. So what's a financial lease? We had discussed this question earlier. Before we get into whether the lease is a financial lease or operating lease, we might also spend some time discussing whether the contract in question is a lease at all, because lease accounting applies only if the contract is a lease. And what's a lease? A lease is something which conveys the right, that is, transfers the right in a specific asset. The right of use of a specific asset is conveyed meaning transferred. Once again, if you recollect from my session 1 or session 2, I distinguish between a lease contract and license contract. A lease conveys or transfers the right to use. A license simply provides or equips the right to use, does not transfer it. Therefore, lease amounts to exclusivity. License does not require any exclusivity. So the contract should be one of a lease and not necessarily a service contract, because the accounting standard on lease accounting is applicable only if the contract in question is a lease. Identified as specific assets, not just a generic asset. Now we are talking from context of 116, and we will be shortly talking about lessee accounting, but let's first talk about lessor accounting, which is where we discuss what's the meaning of a financial lease. Remember, we had mentioned in the first session as well that the meaning of financial lease, while we're still using substance over form test, but the indicators in practice, and in session 1 we discussed that the most important indicator in practice is this one, full payout test. That is the extent of dependence that the lessor has on the residual value of the extent of dependence the lessor has on residual value. Residual dependence, that is in present value terms, that is measured today, if the lessor's dependence on residual value for recovering his investment in the transaction is more than 10. In a sense, if the lessor is recovering by way of prefixed or unconditional so-called minimum lease payments, I've used the term there, minimum lease payments. This is an accounting term, but in practice we could say unconditional lease rental, prefixed or unconditional or non-contingent lease rentals, including any guaranteed residual value, if this recovers 90% or more of the lessor's investment in the contract in present value terms. So present value of MLPs, MLP stands for minimum lease payments, is 90% or more, which means the lessor's dependence on residual value is 10 or less than 10. In that case, the lease is a financial lease. That is, in order for the lease to qualify as an operating lease, the lessor's dependence on residual value in present value terms should be at least 10%, should be at least 10%. The lessor's dependence on residual value should be at least 10 or above. We are using a term, we are using two words here. Number one, present value. Number two, we said minimum lease payments. What is minimum lease payment? Simply speaking, minimum lease payments are unconditional lease rentals. Unconditional rentals which are unconditional. That is, the lease rentals are conditional. For example, they are related to the performance of the asset. They depend on the performance or the output of the asset. I would not call them unconditional lease rentals. Rentals are unconditional because the rentals are pre-agreed or prefixed. Mostly rentals are unconditional. Therefore, that's how lease rentals typically are. It may also include a guaranteed residual value. Guaranteed residual value. Now, once again, if those who were there in the first episode would recall, I'd mentioned that for the lessor, it does not matter as to who has given the guarantee. Guarantee might have come from the lessee, guarantee might have come from a third party, but for the lessor, as long as I have a guaranteed residual value, I'm entitled to say that I have a minimum lease payment because I'm assured of the residual value, and therefore inclusive of the guaranteed residual value plus unconditional lease rentals. If I'm recovering in present value terms at least 90% of the asset cost of my investment in the lease, the lease should be regarded as, if I'm recovering at least 90, the lease should be regarded as a financial lease. The other one is present value. How do you compute present value? Present value is computed at the lessor's internal rate of return. And how is the internal rate of return computed? Remember, there's a sounds like a circular computation. Present value is internal rate of return, which equates the present value of lease rentals with the cost of the asset. Internal rate of return itself is the one that equates present value of rentals with the cost of the asset. And with that rate, we're computing the present value of lease rentals. That sounds like a circular computation. It seems like circular, but remember, it's not circular because when we compute IRR, when we compute the lessor's IRR therefore depends on number one, lease rentals, number two, expected residual value. I've not used the word guaranteed residual value. I've said expected RV. That would mean if the RV is guaranteed, I'll still take the expected RV, meaning I'm hoping to get more than the guaranteed RV. For example, guaranteed RV is 10%, expected RV is 25%. I would take 25% RV. There's no guaranteed RV, but I expect an RV of 20%. In that case, I'll take 20% RV. So I'll take expected RV for the purpose of computing IRR. So for the purpose of computing IRR, I would have taken the rentals, I would have taken the expected RV, arrived at the IRR. With that IRR, I'll compute the present value of the MLPs, which includes guaranteed RV. And therefore, I'll now see whether that present value is less than 90 or more than 90. This is a very important test, and therefore I need to maybe go back and illustrate that. So let me go and illustrate this computation so that we're able to grab this. Okay. Let me just quickly illustrate this. So let's understand this way. Let's suppose cost of an asset is say 1,000. Let's suppose the lease rentals. Let's talk about, let's say, monthly lease rentals. Let's say the lease tenure is say 36 months, and the lessor's IRR is whatever. We'll just compute that. Let's say the lease rentals happen to be say, let's say 39 rupees per month, and we're recovering it for 36 months. And let's say the expected RV, that is, we expect the asset to fetch a value of at least 200 at the end of 36 months. So the lessor's IRR will compute the IRR by, let's say, using one of the Excel formula. I'm here using the rate formula for 36 months, given a payment of 39 rupees for a present value of 1,000, and given the future value or expected residual value to be 200. Let's work out the rate. I'll then annualize that, multiplied by 12 to annualize, just to show it as annual rate. It's working out to a substantial amount. If you think that's too high a rate, but that's how it's working out based on 39 rupees I've taken. If you want, I can reduce it. Maybe I can make it 33 to make it a little better. Or maybe make it 30. That might still make it better. 15% IRR. So the IRR is coming out to 15%. But remember that for the purpose of computing the IRR, what all I've taken what? I've taken the expected RV. Let's suppose that the lessee has guaranteed. There's a guaranteed RV by the lessee. Lessee is guaranteed only 5%. Lessee is saying that I am assuring 50 rupees value. If the asset fetches more than 50, well, you are happy because you are expecting the value to be 200. So if it gets more than 50, then there's no claim on the lessee. If the value is less than 50, in that case, you are right to claim the difference. For example, the asset fetches 30, you can then claim 20 from the lessee. Lessee, of course, cannot guarantee you or the expected RV, which is 200, because lessee is guaranteed only 50. Now, with this IRR, which is based on expected residual value, we compute the PV of MLPs. Which all will be MLPs here? The rentals are MLPs because that's a guaranteed payment. In addition, the guaranteed RV. This part is a part of MLPs. Why? Because this is guaranteed by the lessee. Even if it was guaranteed by third party, it would have still been part of MLPs because this much is guaranteed. I'm expecting 200, out of which 50 is guaranteed. So 50 I'm sure of. I don't have a risk on 50. Therefore, I'll capture that as present value of MLPs. So I'll compute present value PV of the at the rate of the lessor's IRR. I'll compute present value at less. Remember, the lessor's IRR is based on expected RV, but using that IRR, I'm computing the present value for 36 months of a particular payment, which is let's say 30. I'll have to put a minus outside because the numbers are positive. And given the fact that the value is 50, I'll capture that as well. I'll compute the present value of this payment, which comes out to 902. The PV of MLPs comes out to 902, which means there is a dependence to the extent of only 98 rupees on the unguaranteed value, assuming the guaranteed RV was 0. Supposing the guaranteed RV was 0, then the lessor's PV of MLPs is only 870. Lessor has an exposure of rupees 130 on the residual. He's expecting 200 rupees, but in present value terms, that exposure is only 130. That is about 13%, which then makes the lease as an operating lease. That is, if there is no guarantee of RV from the lessee, this lease qualifies as an operating lease. Why? Because the PV of MLPs is only 87%. Therefore, the lessor has an exposure of 13% on residual value, which is sufficient to characterize the lease as an operating lease. But if the lessee guarantees 50 out of the 200, you can now see the lease becomes a financial lease, lessee or a third party. Because now the lease has become financial lease because with the 50 rupees guaranteed, I'm able to recover as much as 90.29%, roughly 90% by way of guaranteed or minimum lease payments. And therefore, my exposure on RV is less than 10%, which is not sufficient to characterize the lease as an operating lease. So that's the characterization of the lease as a financial lease versus operating lease from the lessee perspective, and the role of unguaranteed residual value, which is captured while computing IRR, and the role of guaranteed residual value, which is captured while computing PV of MLP. So PV is computed IRR. IRR in turn depends on estimated residual value or expected residual value. We use that IRR for computing PV of MLPs, which inherently includes guaranteed residual value as well. That's the algorithm for classifying a lease as financial lease versus operating lease from the lessor's perspective. Now we will very quickly move to lessee's perspective. This is going to be a little technical discussion because, as I mentioned, that here we are talking about an accounting standard. The accounting standard is a bit complicated, but let's anyway try grabbing that. So under Ind AS 116 for lessee accounting, very important. For lessor accounting, we will still distinguish between financial leases and operating leases. For lessor accounting, we will distinguish between financial leases and operating lease. For lessee accounting, we do not make the distinction. Very important, first of all. For lessee accounting, we do not make the distinction because every lease will be put on the balance sheet of the lessee as a so-called ROU asset. I'd mentioned that earlier as well. Under Ind AS 116 for lessee accounting, the distinction between financial leases and operating leases becomes unimportant. What matters is the right of use the lessee acquires. That is for the non-cancelable term for which the lessee acquires the right of use. The right of use itself becomes an asset. An ROU asset comes into existence, and that will be put on the balance sheet of the lessee. Now, there are two exceptions there. For the purpose of capturing the ROU asset, ROU, you can publish a ROU or whatever ROU asset, there are two exceptions. It's important to understand the exceptions. Number one, Short-term leases, leases for a term of only up to 12 months. Leases of a term up to 12 months only is excluded from the applicability of the standard, because there you can do a regular rental accounting. The lease term is too short, 12 months only, therefore you can ignore the accounting standard. 12 month, up to 12 month leases. What is the lease? What is the lease of up to 12 month tenure? If the lease has a right of renewal, if the lease has a right of renewal which is reasonably certain to be exercised, then I would take the renewal also as having been exercised. For example, I give a lease for 11 months, but at the end of 11 months, it's reasonably certain that the lease will be renewed. Then I would take renewal also as a part of, in other words, I cannot claim a short-term lease exception if the lease is highly likely to be renewed. In a sense, the short-term lease exception applies only for real short-term leases, which are only intended to be there for 12 months. Of course, we are seeing it prospectively. We are never going to see it retrospectively. But prospectively speaking, if the lease is likely to be, prospectively speaking, looking at the facts of the matter, if the lease is likely to be renewed, highly certain to be renewed, in that case, we will not claim a short-term lease exception. That's part one. Second is low value asset. Low value asset. Low value asset exception in US parlance, the standard talks about a value of $5,000. $5,000 in Indian parlance would translate to 4 lakhs or whatever. But in India, India's 116 has not put a monetary limit. India's 116 is talking about low value assets, such as, it gives examples, such as personal computer, a laptop, a tablet, a personal phone, or standalone office equipment. Standalone office equipment, personal computers, laptops, telephones. These are regarded as examples of low value assets. Now, the word low value asset relates to what is called underlying asset. It's a very important point because a lot of people quite often make a mistake in capturing this. The word is underlying asset. If the underlying asset is a low value asset, what is underlying asset? The asset given, the asset which is subject matter of the lease. The asset which is subject matter of the lease. Now, assuming under a lease contract, a lessor gives on lease 1,000 computers. The lessor gives on lease 1,000 computers. 1,000 computers were given on lease en bloc under a common agreement. En bloc, there is one single rental which applies to all the 1,000 computers. All these 1,000 computers, the rentals are payable on a single day. If at all an event of default occurs, the event of default relates to all the 1,000 computers. In other words, all the terms and conditions of the lease have envisaged the lease to be, the underlying asset to be 1,000 computers and not one computer. The way the construct of the lease agreement is, it doesn't seem to be lease of a single computer. It seems to be lease of 1,000 computers. And therefore, the underlying asset is not a PC, but 1,000 PCs. And therefore, in my view, the question of relying on the low value asset exemption in such a case will not arise at all. And that's my view, though I do understand that some auditors are taking a little different view on this. But in my view, I think the intent is quite clear that if the lessee has acquired a small value asset by way of a lease, it's too small a value to bother about applying a complicated accounting standard, and therefore the standard can be disregarded if the asset in question is a low value asset. But the idea basically is not to use the exception when there are 1,000 computers being taken on lease. So that's the meaning of low value asset. Let's move forward. Now that's the exception, and back there. So moving forward, if the exceptions are not, the two exceptions only, low value assets and small tenure transactions. If the exceptions are not applicable, assuming the exceptions don't apply, in that case, the lessee accounting will be based on ROU asset, recognition of a right of use asset, accounting by the lessee. Let's straight come to accounting by the lessee. The right of use asset. What's right of use asset? ROU asset. ROU asset is the value of the right, the value of the right that the lessee is acquired to use the asset, which means for the non-cancelable term.
For the non-cancelable term of the lease, the right the lessee is acquired to use the asset, that right itself becomes an asset. How do we measure the value of the right? So on the inception of the lease, at the inception of the lease, the value of the ROU asset is the cost which has been paid or which will be paid over time for acquiring the right. Now tell me, what is the cost that we're paying for acquiring the ROU asset? What cost is the lessee paying for acquiring the ROU asset? Quite simply, the lessee is paying the lease rentals, which means at the inception of the lease, the lessee will measure an asset as well as a liability. The lessee will have an asset as well as a liability. The value of the asset will be the present value of lease rentals, and the value of liability also will be the present value of lease rentals. That is, at the present value of lease rentals, an asset as well as a corresponding liability will come on the books of the lessee, right? The two things happen. On the asset side, we got an ROU asset. On the liability side, what do we have? We have an OTP, obligation to pay rentals as a liability. So on both sides, asset as well as liability comes. That's what happens at the inception. Now, over the tenure of the contract, what do we do? Since we brought an ROU asset on the books, we will depreciate the ROU asset. The ROU asset will be subject to depreciation. I'll come as to how is it depreciated. I'll come to that. Number two, the OTP liability will be amortized over time. What is the OTP liability? The OTP liability is the present value of lease rentals. The moment we talk about present value, we're talking about two components, the principal component and interest component. So the interest component will go as an expense and the principal component will go to amortize the liability. That would mean month on month or year on year, as the lease rentals are paid, part of the lease rentals will go as an expense in form of interest and the remaining part will go to reduce the liability, such that at the end of the lease tenure, the OTP liability will be completely squared off. Remember, repeating once again, as the OTP liability is the present value of lease rentals. Now, I'll obviously come as to how is the present value computed. I'll talk about that in a minute from now. But let's park that question as to how is the present value computed. Assuming we computed the present value, therefore the lessee will not be expensing the rentals. Remember once again, the lessee will not be expensing the rentals in his books of accounts. He'll split the rentals into two parts, the interest component, the principal component. Interest component will go as a financing cost in P&L account, and the principal component will go as amortization of that OTP liability. So with the principal component, the liability will be squared off, and the interest part will go as a financing cost in P&L account. Because it's a financing cost, it becomes a interest cost. It's equivalent of interest cost. Instead of being an operating expense, it's now become a financing cost. That's what happens to the rentals. Now, what about the ROU asset? The ROU asset will be subject to depreciation. Depreciation over what tenure? Depreciation over what tenure? Now, here there are 2 points. If the lease transfers title at the end of the lease term, if the lease assures or transfers title at the end of the lease term, for those you recall what I discussed in episode 1, first of all, I said if it's a straight hire purchase contract or conditional sale contract, the transfer of title is almost certain. If the lease transfers title, in that case, depreciation may be spread over the useful life of the asset. Remember, repeating once again, if it's a straight hire purchase or conditional sale type of contract, the depreciation of the ROU asset may be done over the useful life of the asset. That's part one. Mostly, however, if that's not the case, it's not a lease which transfers title at the end of the lease term. Therefore, it's a so-called financial or operating lease which is not promising a title transfer. In that case, the depreciation will be on the lower of the useful life or the lease tenure. Mostly, the lease tenure would be shorter than the lease useful life anyway. Remember once again, I think yesterday also I mentioned that the lease tenure has to be shorter than the useful life or economic life of the asset, because the asset is not even expected to last till the end of the lease tenure. Then the lease has no meaning at all. So obviously, The useful life will be longer than the lease tenure. Therefore, practically speaking, the depreciation of the ROU asset will be over the lease tenure. If the lease tenure is 3 years, we'll depreciate the ROU asset over 3 years. If the lease tenure is 5 years, we'll depreciate the ROU asset over 5 years. But the question is, how do we depreciate? So there will follow our regular depreciation policy. If the depreciation policy regularly straight line, then we will do a straight line we will straight line the depreciation. That would mean we'll linearly depreciate the ROU asset over the lease tenure. So what happens in lessee accounting? Once again, very quickly summarizing, then I'll show a numerical example to hopefully make it clear. I do understand it's a technical topic and therefore a little difficult to grab, but I'll try stating that once again from lessee accounting point of view. Irrespective of whether the lease is financial lease or operating lease, in every lease which is of 12 months or longer tenure and which is not where the underlying asset is not a low value asset, I will apply Ind AS 116, in which case I'll compute ROU asset. ROU asset is equal to OTP liability. ROU asset equals OTP liability, which in turn equals the PV, present value of lease rentals. How do we compute present value? Quickly the question now, how do we compute present value? If the lessor's IRR is known to the lessee, we compute the present value at the lessor's IRR. If the lessor's IRR is known to the lessee, we'll compute the present value at the lessor's IRR. However, assuming the present value is not known, I mean the IRR is not known, in that case we'll compute present value at the lessee's incremental borrowing cost. Incremental borrowing cost means if the lessee was to borrow money for the same asset now, at what rate will he borrow? But quite often in business transactions, the lessor's IRR is mostly anyway known, ascertainable. Therefore, let's assume all practically that we will compute the present value at the lessor's IRR. So we will compute the PV of lease rentals. The PV of lease rentals becomes the value of OTP liability. At the inception, the OTP liability and the ROU asset are both the same. At the inception of the contract, the OTP liability and the ROU asset are exactly the same. That would mean we have the same asset value and the same liability value coming on the balance sheet of the lessee at the inception. Over period, the values will start differing. Why? Because OTP liability is getting amortized, ROU asset is getting depreciated. ROU asset is getting depreciated linearly. OTP liability is getting amortized based on the principal component of the lease rentals. At the end of the lease tenure, both should become zero, but their values through the lease tenure the values are equal at the inception of the lease, the values are equal at the end of the lease, but the values are not equal over the lease tenure. And that's the typicality of lease accounting from lessee perspective. Let me take an example to illustrate this, and which will also show that even if we are doing ROU asset accounting, it may still result into a partly off balance sheet component. To an extent, there might be an off balance sheet component. Take this example, accounting by lessee. Okay. Assuming we have an asset cost of 1,000 rupees, the lease tenure is 4 years. Interest rate or IRR is very low interest rate, 5%, and say I think I'll change the interest rate. It sounds too low to be of practical relevance to this example, so I'll make it 10%. Therefore, the rentals work out to 315. The NPV of the rentals, if I were to compute at the lessor's IRR, the NPV will be at the IRR itself. So maybe I'll change this formula and make it 10%. The NPV comes to at 10. The PV of rentals at 10% obviously comes to the NPV. Lessee's accounting, assuming there is no dependence on RV. It's a full payout transaction. There is no RV at all. The lessor is recovering the whole of his investment by way of lease rentals. The entire lease tenure is non-cancelable, 4 years, and the lessor's IRR is 10%. Therefore, the rental amounts to 315, and the present value of the minimum lease payments, the present value of lease rentals, exactly amounts to 1,000 rupees. Therefore, the PV of rentals, which is equal to the value of OTP liability, which is also equal to the value of the ROU asset are all 1000 at the inception of the contract. So that's how the value becomes at year 0, it becomes 1000. End of year 1. Remember, we are depreciating the ROU asset linearly. So end of 1 year, in year 1 we provided 250 depreciation, end of year 1 becomes 750, end of year 2 becomes 500, end of year 3 becomes 250, end of year 4 becomes 0. Because we're depreciating the value of the ROU asset linearly 25% each year over the lease tenure. Remember I mentioned that if the lease transfers title, in that case I may depreciate the ROU asset over the useful life itself. Assuming the useful life was 10 years, I can depreciate the ROU asset over 10 years if the lease assures a transfer of title. But assuming the lease does not assure a transfer of title, it does not result into a title transfer, it's not a conditional sale or a 1 rupee hire purchase kind of option to buy. In that case, I would depreciate the ROU asset over the lease tenure itself, which is resulting into a linear 25% depreciation. So that's how the ROU asset is looking like over the lease tenure. Now the lease liability 1000, that one is the write-off will be therefore okay, the amount of write-off should actually, let me just quickly see if the values are computing correctly. The amount of write-off is C25 minus this one, C25 minus D38. We are computing it over here. The values, lease payment 315 and interest expense, so that will be taken as 10% value. So I think the interest expense, once we take it correctly, the discrepancy, if any, will go away. So here is the expense, 100 rupees, and likewise for the next year too, the numbers will be taken from here. So that's the expense, so that you can see the OTP liability starts with 1000 to begin with. Next year it becomes 784 because of the lease rentals paid 315 315.47, partly goes towards interest. This amount 215, how do we get it? From the rentals of 315.47, partly it goes towards writing off of liability, partly goes on interest expense, not interest income but interest expense. I'll make it interest expense. Interest expense is what? At the IRR rate, which is 10% of the outstanding principal rupees 1000. So 100 rupees is interest expense. Next period, the interest expense is 78. Third period, 54. Last period, 28.68. Therefore, the resulting reduction of liability is the EMI or the rental minus the interest expense, which is 215, 237, 260 and 286 respectively, resulting into an OTP liability becomes 0 at the end of 4 years. So that's how the accounting is done if the lease is a full payout. I'll change the example. Assuming the lease is not full payout. Let's say the lease is not full payout. Let's say it's a part that is, there is a residual value too. So assuming there's a residual value, say there is residual value of, let's say 20%. Let's say the lessor prices himself so as to compute a 20% residual value, which means now the rental will come down to recover the remaining 80% portion only, and therefore the residual value is now, the residual value is 20%, therefore rentals have come down to 272. And here the PV of MLPs will only be 863 with the 20% RV. Remember, I'm acquiring an asset worth 1000, but what is showing on the balance sheet of the lessee is only an asset worth 863 because the lessee has acquired only 4 years right of use. The lessee has not acquired the remaining 20% value because that is still not a part of the contract. The lessor may actually recapture the asset end of the lease tenure. The lessee's right is limited to using the asset for 4 years, and therefore the value of the ROU asset is only 863, which means the remaining component 1000 minus 863, we have an off balance sheet component equal to 137 whatever, that is 1000 minus 863, 136.60. That's the off balance sheet component, which is anyway not assured to the lessee because the lessee has only been assured of a 4-year right of use. So merely because we follow Ind AS 116 does not mean the entire asset comes on the balance sheet. How much asset comes on the balance sheet is only what is assured use by the lessee. Supposing the lease tenure is limited to, let's say, 3 years, the asset has a life of, for example, 10 years. The lease tenure is limited only to 2 years, and the asset has a significant RV. For example, say the RV is 50%. Let's say the term is only 2 years and the value is limited to the RV is 50%. That would mean the lessor is recovering only half the cost of the asset by way of lease rentals, which may be only over a shorter period. That still leaves a significant off balance sheet component. So the on balance sheet accounting by the lessee depends on what is the assured right of using the asset by the lessee. That's the essence of lease accounting by the lessee. As for the lessor, once again, very quickly, financial lease versus operating lease. If it's a financial lease, lessor will be reflecting only a receivable. Lessor will not be booking the rental as income. Lessor will be booking only the interest as income. The question of lessor depreciating the asset does not arise, as the lessor does not capitalize the asset. From lessee perspective, lessee brings on books an ROU asset which is depreciated, and the interest component of the lease rentals goes as an expense. So as a result of the Ind AS 116 applicability, what's happening earlier, what was an OPEX, earlier what was an operating expense, namely the rental expense, has now been broken into two components. Number one, depreciation. Number two, interest. Both of these are what you call post EBITDA item. If you're looking at the lessee's EBITDA, earlier, as per earlier operating lease accounting, it was a rental expense, which was pre-EBITDA item. But now the interest cost as well as depreciation are both post EBITDA items. That's the lease accounting. So I think that's where we park for today. Let me ask if anyone has any question. If you can do a hand raise, so I am able to assess how many questions there are, and then we can maybe pick up the questions one by one. Any questions at all, anyone? There is a hand raise by Anita. Anyone else who has any question? If at all you quickly want to ask yourself, do I have a question? No, it's not necessary for you to have a question. So don't strain yourself to ask a question. If you have a question, naturally ask it. If you don't have a question, just don't worry. Anita, however, has a question. So Anita, go ahead.
So you mentioned about the low value assets. If there is a single lessor who is giving out, say, for example, mobile phones to an employer for leasing it out to the employees, and the mobile phone as a single asset is low value, but if I'm giving it out to the same employer for several of its employees, will it still be considered as low value, or do I have to look at it individually or as a composite lease?
What is the subject of my lease?
The mobile phones.
One phone or 1,000 phones?
It will be 1,000 phones.
Therefore, it's not a low value asset.
So if I just maybe have
But
different lease agreements for
what distinguishes the asset as a low value versus high value asset is not the value of an asset, the value of the underlying asset. Underlying asset meaning the subject matter of the lease. Is the subject matter of my lease 1,000 phones or one phone? If the subject matter of lease is 1,000 phones unblocked put together, as far as I am concerned, I have viewed this contract as a contract for lease of 1,000 phones. I'm once again cautioning that there are people who take a different view, but my view is quite simple: that if the parties have envisaged lessee is acquired right of use of 1,000 phones, those 1,000 phones will be used by 1,000 people. That's a different issue. 1,000 phones can never be used by one person. It obviously will be spread over 1,000 persons. But the question is, has the lessee, by virtue of this lease, acquired a right to use a single? What is the rationale for the low value asset exemption? The asset is too small of value to apply such a esoteric, complicated accounting standard. But here in question, we don't have one phone; we have 1,000 phones. So I think to apply the low value test exemption, looking at the value of an individual asset, if what we are acquiring on lease is 1,000 assets, but I'm not saying that this contract could not have been structured as a lease of 1,000 phones. For example, so I'm trying to think of what could be done to make it a lease of 1,000 phones, not one lease of 1,000 phones together. What could have probably been done if we had, for example, the rentals were expressed as per phone, the right of use was exercisable for example, if I give 1000 phones, and there's a right of, let's say, returning any phone any point of time. That right could have been exercised for one phone. Continuing the lease for 999 phones, I could have maybe repurchased only one. In case of a default, let's say event of default, I would exercise my right only for one phone. In a sense, if the parties so visualize that while there are 1000 phones, but the rights of the lessor and the obligations of the lessee are exercisable with respect to a single asset, possibly it's possible to argue that it's lease of each asset becomes the subject matter of lease and not 1000 phones put together. This is reminding me of a provision which existed in income tax law earlier, long time back, 1997. There was an income tax provision which said if the value of an individual asset is rupees 5,000 or less, you could have claimed 100% depreciation in the very first year, which is what led to absurd practices in leasing industry, lease of electric meters, lease of tools, jigs, balls, glass bottles, lease of weird amount of small value assets which were contended to be small value assets, and therefore people would claim them to be 100% depreciable. There again, there were significant amount of tax rulings against it, but I'm not here concerned with tax rulings. I'm here concerned with use of a de minimis exemption given by accounting standards, which is based on the low value. If the collective value of the assets is 1000 phones into the value of iPhone, I don't think it's justifiable to claim low value exemption. That's my perception.
So second question was on the lessor IRR. We discussed the computation of how the lessor IRR is computed. You also mentioned about the lessee IRR. What are the instances in which both the lessor IRR and the lessee IRR?
There's no such thing called lessee IRR. IRR as a concept applies to the lessor. Internal rate of return. Who is getting the return? Lessor.
Lessor.
So we said if the lessor's IRR is known, then that becomes the discounting rate for the lessee. Lessor's IRR is known to lessee, then that becomes the discounting rate. If not, then the lessee's incremental borrowing cost. Concept of IRR as such does not apply to a borrower. IRR is what is applicable to a lender, not a borrower. Borrower is the cost. So incremental borrowing cost, meaning had the lessee not gone for the lease, at what rate would he have borrowed? That becomes the incremental borrowing cost for the lessee. So discounting rate for computing PV of the lease rentals for the lessee would be either the lessor's IRR or the incremental borrowing cost.
Understood.
Kasim?
So we were discussing on the accounting of leasing, but most of these arrangements also have an option. So lessor is providing an option to sell the assets to the lessee, and lessee has an option to buy the asset. Do we need to separately give effect and the accounting to this option as well, or is it taken care by the lease accounting itself?
Kasim, as for the lessor is concerned, if there is an option, if it's a bargain purchase option, the lease becomes financial lease anyway. If the option is at a bargain price meaning at which it's reasonably certain that the option will be exercised, that makes the lease an operating financial lease anyway. For the lessee, all that matters is if the lease transfers title. In that case, I will depreciate the asset over the useful life itself. Otherwise, I'm assured of only right of use. Option is an option after all. The option may or may not be available. The question of using the option for capturing ROU asset for the lessee, the question does not arise. In other words, the option is this. I mean, Kasim, you're probably looking at option accounting. Option accounting is relevant in case of derivatives. This one is a transaction with real assets. In case of a real asset, an optionality which is embedded in a real asset, a real asset transaction, I don't think the option need to be separated there. So to my mind, I think option accounting will not be relevant, but if the option is a bargain purchase option, for the lessor, it will have impact of converting the lease into a financial lease.
Okay.
Neetu Pandar.
So you, while in the accounting of in the books of lessee, you mentioned we take only the ROU asset, but you also then at like the end you also mentioned about taking it the difference part as OCI off balance different part as off balance sheet.
No, I said The ROU asset is simply the present value of lease rentals. That may or may not be equal to the actual value of the asset. Like in the last example where there was a significant residual value, the value of the asset is 1000, but I am assured of using it only for 4 years. And the value of that works out to only 830. That would mean 170 is still off balance sheet component. That's not my asset. I'm using an asset worth 1000. So what? I will be able to use it only for 4 years. And during the 4 years, the value of that right of use is only 830. So I'll book that asset, that value in my books. I hope there's no confusion on that. The value that comes on the lessee's books is the value of the right of using the asset over the lease term, which is the present value of lease rentals. If the lease is a full payout transaction, that present value will be equal to 1000 anyway. But if the lease is not a full payout transaction, then that value may not be or will not be equal to 1000.
And the difference part you say will remain on, it
Will
won't.
remain, will not enter the lessee's books at all, because the lessee doesn't have that value.
Okay.
So I'm guessing there's no other question. And if not, in that case, we close it for today. Tomorrow we will discuss taxation aspects of, so I think we have 2 more topics left, taxation and then GST. Taxation meaning income tax. Next question will be GST. So tomorrow and day after we'll hope to cover the remaining 2 aspects, and that would complete our series on basics of leasing. So tomorrow, same time, 1485, we will discuss the income tax aspects of leasing, which is where we also intend to discuss a bit on car leasing, which is grown in a particular way in India. We'll discuss the tax aspects of car leasing and thereafter the GST. Thanks for today. Bye-bye.